Welcome everyone. Today we have gathered here to talk about IFRS 16 and the implications to financial reporting. Right, so before we go into the standard and the agenda for today, I would like to give you a brief introduction of myself. My name is Umasudhan. I'm a management consultant, corporate trainer, and lecturer. I have been into commercial sector over the last 20 years into different sectors: commercial banking, investment research, manufacturing, trading, so on and so forth, holding different positions in accounting, finance, and strategy and analysis. Right, so today's agenda here is IFRS 16, and before we go into the topic, right, I would like to talk to you about something general so that we have a fantastic webinar experience. So the objective is to have the session as interactive as possible. So I would like to take up any questions during the session, probably during the session when we are talking about it. If you have any relevant questions, you can post it at that point in time. You can use the chat option in Zoom, which is what I usually always prefer. And make sure when you are using the chat option, I recommend you choose the question, you choose your all panelists and attendees when you are starting the question. Right, so basically that's the first thing that you got to ask the question. I highly recommend you ask the question to panelists and attendees. So when I'm answering a question, everybody can actually see what I'm talking about. And then, and also we will have a dedicated Q&A session at the end of the program. And also we have a break in between for about 10 minutes, right? So the objective is to have a fantastic experience. And if you have any problem, you are not able to hear me, you're not able to see me, please raise it up and then I can see what's going on here. Right, so maybe, okay, I can speak a bit. Hi, hopefully you guys can hear me. Hello everyone, can you guys hear me, see me and hear me very well? All right, so that's fantastic. So let's get into the topic today, and we are going to talk about IFRS 16 leases, lease accounting, and I'm going to start sharing the agenda today. And remember, we got a lengthy agenda over the next 3 hours talking about the financial reporting implications of the new accounting standard IFRS 16 leases. Not just the financial reporting implications, but also talking about the implications for analysts, implications on the valuation of companies, and also most importantly, pay attention to lease modifications, as well as how the rental rebates and concessions which are given by the lessors to lessees as part of the COVID-19 support mechanism, and how to account for them, and what is the view of International Accounting Standard Board on accounting for such rental concessions and rebates. So we'll pay attention to that, and we also talk about sale and lease back a little bit at the end, and then we take up question and answer sessions. As I told you previously, if you feel you want to ask a question at any point in time during this session, please send the question in the chat option. I would be happy to take it at that point in time if I feel that it is relevant for the topic that we are discussing at a given point in time. Right, so let's get going now. I'm going to start sharing my slides and make sure that you are able to see that, and let me know if you are not able to. Here you go. So we're talking about, so this is basically what it is. IFRS 16 leases is the topic, and we got a lengthy agenda as I told you previously. These are the topics. We are first going to talk about what was the previous accounting standard before IFRS 16 was introduced. So we're going to talk about IAS 17 and what was wrong with IAS 17 and what was the consequence to the financial markets. And then the scope of IFRS 16 leases, we'll talk about what is covered in this particular standard. And then we will talk about the key terminology and definitions in the standard, quickly wrap them up and move on to lessee accounting treatment with illustrations to make it more practically relevant. So I have used real world examples to talk about lessee accounting, and then we will talk about the impact on financial statements, ratios, and valuation. This is super important for of us to understand what the impact on ratios and valuation. End of the day, financial reporting is all about, providing the right information to the users of financial statements so people can make well-informed economic decisions, right? So moving on to reassessment and modifications, and then how to talk about rental rebates and concessions. And this is one of the reasons why I decided to do a standard a session on IFRS 16. The standard became popular last year, 2019, with the standard becoming effective on 1st Jan 2019. And there is some renewed interest on the standard in 2020 with there is so much of stimulus program announced by various stakeholders around the globe, including the central banks, governments, and lessors. The lessors have given extended period of rental rebates, waivers, and concessions, and how to account for them. What is the view on accounting standard board on that? And we are going to talk about that. And then we are going to talk a little bit on the lessor accounting treatment, sale and lease back. And we wrap it up with the key takeaways of this new standard, and based on what we discuss mutually in this 3-hour webinar, right? So if you have any questions, we can take it up now. And I'm going to move on to slide number 3, where we are going to talk about the key issues that were there in IAS 17, right? So this is kind of a very important for you to understand what made accounting standard setters to transform IAS 17 into IFRS 16, making transformational and radical changes in the accounting for leases in the books of lessees, right? So before getting into this, I just want to make sure that we guys, all of us are in the same page. So I would like to talk about slide 6 so we know what we're talking about. I know you guys are kind of, holding senior positions in finance, but, it's very important that we understand these key terms before we dive deep into advanced topics in the standard, right? So if you look at a lease agreement, there are two parties in the lease agreement, a lessee and a lessor. And the lessee is the guy who's going to use the asset, and he's going to pay periodical rentals to the lessor. And lessor is going to be the absolute owner. He got the legal ownership of the asset. So he's going to receive the rental income from the lessee, and he's going to give his asset to the lessee to be used over the lease period. At the end of the lease period, maybe the ownership is transferred to the lessee, or maybe the asset is returned back to the lessor. So, it could happen either way. So that's basically a lease definitions, the most important things that you need to be familiar with when I'm talking about this standard. Lessee is the guy who's going to use the asset, but he doesn't own them. But lessor is the guy who's going to own the asset, and he is the legal owner of the asset. So going into IAS 17, what went wrong in IAS 17? If you go back to IAS 17, the leases in IAS 17 are classified into two major categories. The leases were classified into finance leases and operating leases, right? So there were two lease categories, finance leases and operating leases. And we in the standard, we used to classify leases into finance and operating leases based on the risk and rewards, right? So what happens? What is the finance lease? When the risk and rewards of using an asset is transferred by the lessor to the lessee, and that is what we call a finance lease. So in an operating lease, the risk and rewards of using an asset is with lessor. It is not transferred to the lessee. And remember, I'm talking about IAS 17. We are not yet into IFRS 16 standard, but I just wanted you to understand, get a perspective into what was a major issue in the IAS 17. So when we are talking about IFRS 16, it makes more sense when you look at the standard or the adjustments, even the advanced aspects of the standard. It gives you a perspective to understand, okay, what was the issue in IAS 17, which made accounting standard setters to come up with a revised standard on IFRS 16 leases. Right, so now, as I told you, risk and rewards are transferred by the lessee, the lessor to the lessee. So what these risk and rewards could be, right? It could be basically the maintenance and repair work of would be done by the lessee when it comes to finance leases. Insurance would be done in the name of the lessee. There might be a bargain purchase option for the lessee at the end of the lease period for the lessee to buy the asset by paying a nominal value to the lessor. Or there could be various other conditions relating to the lease. And one of the very important things that I always say about in finance leases, the lessee is going to use the asset for most of the useful life of the asset. For example, let's say you got an asset with a 10-year useful life, and the lease period is, let's say, 8 years. So what does that mean? Although the asset is owned by lessor, right, it is going to be held by lessee for most of the useful life of the asset. So in that case, we said that was finance lease because the risk and rewards were transferred to the lessee, isn't it? So these are kind of the factors that we used to classify into leases. And one final thing, the technicals are a little bit technical, where they say the present value of the lease payments which the lessee pays to the lessor is 90% or greater than 90% of the fair value of the asset, which means the lessee is pretty much buying the asset because he's paying 90% of the market value of the assets in present value terms. So under those circumstances, we classify a lease into a finance lease. Any other leases were classified into operating leases. Now, what was the issue in IAS 17? Not the finance lease accounting treatment, because when it comes to finance lease accounting treatment, there was an asset recognized in the balance sheet reflecting the assets used by the lessee, and there was a liability reflected in the balance sheet of the lessee, and which reflects the rental repayments which needs to be paid to the lessor. So in a finance lease, if you go back to IAS 17, in the finance leases, you have assets and a liability. You have an asset and a liability in the balance sheet of the lessee. And remember, we are actually focusing on lessee accounting treatment because lessor accounting treatment was never a problem. The problem was lessee accounting treatment. That too, the problem was not finance leases, because in a finance lease, the lessee is going to show an asset. The asset is going to reflect the asset that they are using, and the liability is going to reflect the money that needs to be paid. So you got an asset and the liability, and then very often people ask me that how can you show an asset in the balance sheet which the lessee does not own? Even the same question was there in IAS 17, isn't it? And that's why we in accounting, in the world of accounting, the focus is on substance. So we say substance over legal form. So we focus on substance. So based on substance, the assets are recognized in the books of lessee when it comes to finance leases. So what was the major issue in IAS 17 was the accounting treatment of operating leases. So now let's talk about, okay, let's get your views. I mean, what do you think the accounting treatment was when it comes to operating leases? What was the accounting treatment for operating leases in IAS 17? I'm trying to make the session more interactive so that that actually happens if people starting to talk and send me questions or your point of view, your opinion on the standard, right? So there's a question here from Anton. Yes, IAS 17 was replaced by IFRS 16. So that's exactly why we are actually talking about IAS 17, talking about the key issues in the standard, which is why there was a new standard IFRS 16 was actually introduced, right? So that's about it. So if you have, I mean, what do you think was the accounting treatment when it comes to operating leases? How the operating leases was treated in IAS 17? Anybody wants to talk about it? How did we account for operating leases in the books of lessee when it comes to IAS 17, where we are talking about the old standard? Okay, there's an answer here from Safan. I mean, I highly recommend when you are using chat options, unless if you are a very shy person, please use the chat option to all panelists and attendees, so everybody could actually see what you are talking about. So that way we can make the session not boring, right, and highly interactive and useful for all the participants. So this is the answer I got. In operating leases, the rent payment was simply reflected as an expense and no assets and liabilities recognized. So that's a fantastic response. Yes, that's exactly right. In operating leases, we recognize the expense as a one expense in the income statement. So every period you pay, the lessee pays rental expenses to the lessor, and that gets charged into the income statement. With no assets recognized in the books of assets, in the books of lessee, and no liabilities recognized. Now there will be a question, okay, why do you think there needs to be an asset recognized in the balance sheet of the lessee? Because he is using it. He has control over the usage of the assets, and he has a right to use the asset, right? And then if you look at it on the other hand, when you talk about liabilities, the lessee has a liability to pay periodical lease rentals over the lease period, X number of years, to the lessor. There's a liability, there's an asset, so that needs to be reflected in the balance sheet of lessee. And that's why we say the operating leases accounting treatment, which was the culprit behind IAS 17, right? In that, we call this off-balance sheet financing. I mean, which is kind of a popular term that we use when you talk about window dressing and things like that. Off-balance sheet financing is all about companies financing assets without showing a liability in the balance sheet. So that was kind of an issue when it comes to IAS 17, off-balance sheet financing of operating leases, where companies were hiding large amount of liabilities and assets from their balance sheet, And so what are the implications for financial reporting? Your debt in the balance sheet is going to be understated. Then so when you say your debt in the balance sheet is going to be understated, your debt to equity ratio is going to be understated. Your financial leverage is going to get understated. And now what's going to happen when you're talking about measures like return on assets and asset turnover ratios? Any views? What do you think, due to the operating lease accounting treatment in IAS 17, what do you guys would actually think would have happened to return on assets? Let's talk about return on assets. What do you think, guys? What happens to return on assets when you talk about operating leases, where the lessee is going to charge the lease payments to the income statement without creating an asset and a liability, right? So that's basically what we are talking about. So what's the impact on the financial statements? The impact on the financial statements is that you know, your gearing ratio is going to be understated, and what's going to happen to the assets? Okay, that's a very interesting statement from Prasanna. Yeah, thank you for pointing that out. So I'll share it with everybody. What you just mentioned is that, okay, that's exactly there. I mean, if you see, that's an interesting slide. If you see, you know, Sir David, and he was one of the former chairmen of International Accounting Standard Board. He once said, if you see, one of the great ambitions before I die is to fly in an aircraft that is on an airline's balance sheet. So what does that tell you? So if you look back into operating leases, and most of the airlines, their one of the key assets, or probably rather the key asset of an airline is aircrafts. And how do you like it if aircrafts are not on the balance sheet because they are on an operating lease? So if they are on an operating lease, these airline companies were able to not show those assets as well as the liability relating to the lease from their balance sheet. So which meant that you never had an asset in the balance sheet and you never had a liability, right? So that's it's a coincidence that what just Prasanna mentioned is actually apparently is my fourth slide. You know, this was the key issue. So what actually happens when it comes to, so if you are using an asset and you are using an asset and you are generating revenue from the asset, but that is not reflected in the financial statements, in the balance sheet. So which means your return on assets is going to be overstated. Why that is going to be overstated is because you don't have an asset in the balance sheet, so your denominator is going to be nothing or lower, and then you are going to have a revenue coming from the asset on the numerator. So return on assets, how do you calculate? Profits divided by assets. So that's going to be overstated. Your asset turnover ratio is going to be overstated simply because you do not have an asset in the balance sheet as well as a liability. So what happens? I mean, again, what was the issue? Most organizations, they were misclassifying operating finance leases into operating leases, and there were motivations behind such misclassifications, because the motivations to classify is basically to increase the debt capacity of an organization. When do you think a company's debt capacity is going to go up? When the company has less liability, better solvency ratios. So they wanted to always keep these liabilities off the balance sheet. So they always misclassified finance leases into operating leases so they can get away from recognizing an asset and liability from the balance sheet. So this was operating leases accounting treatment in IAS 17. If you see the red box, was a key reason for many accounting scandals in the world, and one such great example is Enron, right? Enron, if you look back into their balance sheet just before they went into bankruptcy, or if you look at the years leading up to bankruptcy in 2001, around 20 years before, if you look at their balance sheet in 2019, 98, 99, the balance sheet, there's nothing to complain, nothing to really worry about, nothing was really alarming, because the company had so much of operating leases and the liabilities were there, but they were not there on the balance sheet. So they had a huge operating lease commitments payable to the lessors, which was hidden from the balance sheet because they classify them as an operating leases. And that's one of the reasons why, overnight you saw Enron going into bankruptcy, and who is to be blamed? There are so many parties involved, they need to be blamed, and obviously accounting standard setters need to take their share of the blame, isn't it? So that's when accounting standard setters starting to think about coming up with a new revised set of accounting standards with the US Accounting Standard Board. There was an agreement signed called No-Walk Agreement in 2002 to harmonize the accounting treatment between US GAAP and IFRS. Right, so that's when we started talking about this ratio, this issue. So now we're going to actually see how the new accounting standard on the leases, which is IFRS 16, lease accounting, how this is going to solve the existing issue on the accounting treatment with operating leases. So that's going to be our key focus point in the next couple of slides. Okay, this is going to be the scope of the standard before we get into IFRS 16. So now we clarified the reason why there was a change. There was a reason for a change in operating leases or change in IAS 17 accounting treatment, and that is why the accounting standard setters came up with IFRS 16. So in the IFRS 16, the scope of the lease, we're actually going to talk about lessee accounting treatment, lessor accounting treatment, and sale and leaseback transactions. So there's going to be 3 elements, and my focus today is going to be lease accounting from lessee's accounting, lessee's books of records. Why? Because IFRS 16 did not change lessor accounting. Lessor accounting in IFRS 16 is pretty much the same as the lessor accounting in IAS 17. So there's nothing much change. And also remember something very interesting. This is one of the standards where you see the classification of leases are removed in lessee accounting, and it is still there in lessor accounting. So still more changes are yet to come in IFRS 16, where the accounting standard board trying to align lessor accounting with lessee accounting. So at the moment there is obviously a disconnect where the lessor accounting treatment still uses the old classification. So you have the finance leases, operating leases definitions, they are completely removed from lessee's accounting perspective. But when it comes to lessor accounting, remember you still retain those definitions, finance leases and operating leases. And so lessee accounting, we talk about lessor accounting, which has not changed much, but we briefly touch them upon towards the end of the presentation, and then we'll talk on sale and leaseback transactions. So we spoke about what is a lease. Lease is an agreement between lessee and lessor for the lessee to use the asset for a periodical rental payable to the lessor. So that's basically leases. Now we are directly going into IFRS 16, lessee accounting. So we're going to talk about how IFRS 16 overcomes the issue in IAS 17, where we said operating leases were used as off-balance sheet financing to hide liabilities in order to improve the solvencies. So how this standard is going to address? Remember, any type of leases, right, they need to be on the balance sheet of the lessee. So the lessee cannot use off-balance sheet financing as a mechanism to avoid liabilities, avoid recognizing assets and liabilities. So remember, any type of leases needs to be on the balance sheet. Now, there are exceptions. Obviously, there are exemptions here for two types of assets, which we will talk about it. But remember, for most of the assets where the useful life is more than 1 year, right, there needs to be an asset which we call right of use assets. And why do we call right of use assets, and how this is different from your property, plant and equipment or investment properties? It is actually different. Why? Because you are actually not owning the asset. You don't own the asset, but you have a right to use the asset. So that rights to use needs to be on the balance sheet. So that's the point here. And then you should show a liability, and a liability reflecting the lease payments that needs to be made by the lessee to the lessor. So that's the summary. And let's talk about the look at the summary highlights. IFRS 16 eliminates classification of leases into finance and operating leases in the books of lessee, single accounting model for lessees or for leases in the books of lessees. What do you mean by single accounting treatment? Previously, you had a different accounting treatment for finance leases, and there was different accounting treatment for operating leases. Now you just got one, because there's no need for you to worry about whether you got a finance lease or you got an operating lease when you are accounting for them. So you just can go with a single lessee accounting model, and you will have to show a right of use assets and a lease liability. Okay, this is a very important slide. Okay, do we have any exemptions from recognizing an asset and a liability in the books of lessee? Right, there are obviously two exemptions. One exemption is that the lease term, if the lease term is less than 1 year, such assets, such lease contracts can be expensed into the income statement without recognizing an asset and a liability. Or you probably have more than 1 year lease, but the underlying assets are of very less value, or rather negligible. Think about printers and scanners, or the office chairs that we use, which is there in the diagram. So they are assets of low value. For these type of assets, lease contracts, you can still go ahead and expense them without recognizing a right of use asset and a lease liability. Right, so that's the most important point. And now this is kind of a very important thing to remember when it comes to lease accounting, is that we use substance over legal form. Right, how do you handle lease contracts for rentals? So I'm going to talk about renewable annual lease contract. This is a very important, or rather a practical issue for most companies. How do we account for annual lease contracts? Let's say the useful life, the contract period of the lease rental contract, let's say, is 1 year. Let's take a practical example. You have a supermarket chain, and you have branches all over the country or all over the world, right? And then you have taken most of your branches are on rental premises. You pay rent, and most of your rental contracts are for 1 year. Now, my question to you is, now, how do these companies account for these leases in IFRS 16? And this is one of the areas which dramatically changed in IFRS 16 from IAS 17. Right? Any views from you guys? How do you look at renewable annual lease rental contracts? So essentially your contracts are less than 1 year old. It's not more than 1 year. So basically, if you look at it that perspective, how do you account for these type of leases? Renewable annual lease contracts, how do we account for them? Any idea, guys? Like, how do we account for renewable annual contracts? Do we take the exemption route, or do we recognize an asset and a liability in the balance sheet? So I leave this question to the audience. If anybody has an understanding or have practically used, please share your experience for the benefit of everybody around there. We have hundreds of people from all over the world, so it's a great opportunity to engage and share your opinion, and kind of have a very good knowledge sharing session as well. So I encourage you guys to talk and share your experience as well. So what do when it comes to annual lease rentals and contracts, and how do we account for them? Do we follow the exemption rule because the lease contracts are less than 1 year? Right, so now this is an answer from Anton here. We have to recognize the liability since it is renewable. Right, so yes, that's exactly right. And remember, you look at substance over form, and you look at historically, have you been renewing your lease contracts on an annual basis? So if that is the case, even though your lease contract, the rate for rental is less than 1 year, you still need to recognize an asset and a liability. So how we do it, the value of the asset is equal to the value of your liabilities. What does that mean? So you have got your liabilities payable to your lessor over the next 5 years or so, and you discount those cash flows because they have future values. When you're discounting them, the present value of your liabilities, which are payable to the lessee, will become your right of use assets in the balance sheet. So you're going to discount your lease rentals and arrive at the present value, and that becomes your assets and a liability. Right, so that's what we do for annual renewable lease contracts. So substance over form, remember that. Right, so basically that is on slide 10. So we are moving further down. Okay, there's a question. Okay, that's a very interesting question from Ibrahim. Right, I think again I highly recommend the questions. It is better if you could ask the questions from all panelists and attendees. The problem with Zoom is that it always gives you a default chat settings to only chat with me, so I can only see your questions. But please, if you can change, take a moment and change the chat settings to all panelists and attendees. That would be great. So that's a great question, how to determine the number of years. Now, the thing is, you need to look back and see historically how many years have you been in the same place, same branch, or operating from the same place over a period of time. Management has to use their judgment, how many years. They should definitely have internal business plans and strategies to know how long they are going to operate the branch in that particular place. So there needs to be some judgment made, and based on that, if you use, like, let's say 5 years, then as you say, you forecast your rental cash flows for the next 5 years, discount them, and that becomes your right of use assets and liabilities. So you definitely, there is some judgment involved, but judgment cannot be just an arbitrary assumption, but needs to be supported by their business plans, historical experience, etc. So it needs to be done more scientifically than just arbitrarily using a number of years. So hope that helps, Ibrahim. Okay, now, yeah, so now, okay, that's a very good question again, but you run the risk of cancellation in the short term, so it is correct to capitalize. So that's kind of, again, another question that have come up. The point from Prasanna is that, interesting point, you run the risk of cancellation in the short run. So now, the thing that what I would like to tell you is that if you think about a lease, you have a cancellation option, right? So the risk of cancellation or early termination in the lease should be part of your present value calculation itself. So in IFRS, you know, they say you cannot avoid recognizing an asset or a liability unless you feel it's highly likely your lease will be terminated in 1 year. If that is the case, there is no point of recognizing a liability. But if you are going to show a liability but there is a possibility of early cancellation of the lease, then your present value calculation or forecasting needs to include such risk into the calculation itself. So that's what we basically do, right? So you need to capitalize, but your capitalized figure will incorporate the risk of an early termination. So you would lower your cash flow to that extent. So that's what is recommended in the standard. Right, so now going further down into the next topic, before we go into and look at an illustration of how this is done. So this is kind of important slide 13. Can you identify a lease? Right, can you identify a lease? Yes or no? If you can identify a lease, yes, then it becomes a lease. But if you cannot identify a lease, there is no lease, then you cannot use IFRS 16. So first of all, when you're talking about a lease contract, you need to understand whether can you identify a lease or you cannot identify a lease. If you cannot identify a lease, then that has to be accounted for using the relevant accounting standards for that. Right, so moving further down, let's look at an example to understand what we mean by identifying a lease. Look at this example. XYZ company provides tours around places of interest in the city, tourist city of Sightsee. While these tours are mainly within the city, it does the occasional day trip to visit tourist sites further away. XYZ company has entered a 3-year contract with Fast Coach Company for the use of one of its coaches for this purpose. So who is the lessor? Looks like XYZ company is the lessee and Fast Coach is going to be the lessor, looks like, but we don't know whether there is a lease contract here or not. But we are just trying to understand whether there is a lease or not. So basically you see that there is this is a 3-year lease contract, and then you have XYZ, he's the lessee, and then you have a Fast Coach is a lessor. So what's happening? XYZ is using one of the coaches of Fast Coach. He is going to be the lessor. So you see what's happening. The coach must seat 50 people. But look at this. Fast Coach Company can use any of its 50-seater coaches when required. So what does that mean? Right. Which means the Fast Coach can probably give a coach today, and tomorrow they can give them a different coach, and in a month's time they can change the coach into something different. So meaning that we cannot identify a lease. So if a lease is not identified, IFRS 16 is not applicable. You need to use the relevant accounting standard. In this case, I would actually think whatever the money payable to the Fast Coach by the XYZ company needs to expense them. IFRS 16 is not applicable because the lessor can change the assets. So in such a manner that they can benefit economically by doing so. So let's look at the answer here. Is this a lease? This is not a lease because there is no identifiable assets. Fast coach can substitute one coach for another and would derive economic benefit from doing so in terms of convenience. So therefore, XYZ should account for the rental payments as an expense in the P&L. IFRS 16 leases is not applicable. So we are moving on to the next slide, and this is a very, very important slide. This summarizes the lessee accounting treatment just in a diagram. So what happens? At the inception of the lease, at the commencement of the lease, the first thing that you need to understand, do you have a lease? Do you have an identifiable asset? If yes, there is a lease. So what you need to do, you need to recognize in the books of lessee, right? You recognize the right of use assets, and then you have a lease liability, isn't it? So what you do, I mean, we are going to talk about this in detail using illustrations in the next couple of slides. And before we move on to lease modifications, so we'll go into a little bit detail here now in a while. So you look at this right of use assets. So when you talk about right of use assets, it depends on whether you're talking about a machinery, equipment, property, depending on the nature of your underlying asset, and you have various options available depending on your purpose of leasing and the nature of the assets. The assets are part of IAS 16 property, plant and equipment, or IAS 40 investment properties. You can choose to use historical cost approach in IAS 16, or revaluation or fair value model in IAS 40. You can, when you have actually recognized the right of use assets, you can simply depreciate them over the lease period or the useful life of the assets, whichever is lower, or you can periodically fair value them and take the gain or losses to your other comprehensive income via revaluation reserve, or you can use fair value model in IAS 40 where the gain or losses on the fair value increase needs to be taken to income statement, right? So that's something that you've got to decide when you show a rights of use assets. And then on the liabilities, you know, you have a liability in your balance sheet, and that needs to be gradually reduced to make it zero at the end of the lease period. So now this is something very interesting. When you talk about an operating lease, you just have one liner called operating lease rental. And remember, that one is going to be divided into two line items in the income statement of the lessee. So what are those two line items? Anybody wants to talk about it? What are those two line items which is going to replace operating lease rentals in IAS 17? So there's going to be two lines going to come up in your income statement instead of just one line in operating leases, which is what you call operating lease rental, and which usually goes in your cost of sales or your operating expenses, admin expenses, or sales expenses, depending on why you are using that asset, isn't it? But when you are moving into IFRS 16, what are those two lines in the income statement which is going to replace your operating lease rental in IAS 17? Anyone wants to talk about it? What are those two lines which are going to replace just one line in the operating leases? Are we here? Anyone wants to talk about it? So obviously you have an asset. So if you've got an asset, so what's going to happen with the assets? If you have a rights of use assets, obviously the assets are going to get depreciated. So you have a depreciation coming up in your income statement. That's exactly right. That's exactly right. Ravi Kumar, Aruna, there you see now people starting to send messages to everybody. Super. So you have depreciation and interest. So you have a right of use assets, then you've got a depreciation coming up as you depreciate your assets, and you have a liability. So your liability needs to be repaid by periodical lease rentals, and the lease rentals has got two elements into it, principal and interest, that needs to be split, right? So from a P&L perspective, nothing much really changed. It is just that previously you had only one line for operating leases, but now you're going to have them in two lines. One is depreciation and one is your interest, right? So we'll talk about them in detail, and then of course your liabilities need to be broken into current liabilities and non-current liabilities. This is a summary of the standard, but we are going to go in detail. And I think slide 16, I would like to spend some time on slide 16 because this is something very important which I believe on this particular standard. Now, let's take an example, pay attention to my example in the chat. Let's say you have a lease agreement with a lessor. You are the lessee, and then let's say I'm the lessor. So you're leasing an asset from me for 5 years, right? Let's say 5 years is the useful life. The 5 years is the lease term. And so from year 1 until year 5, right, you're going to pay me a lease rentals of $100,000 each year. So you're going to end up paying, how much are you going to pay altogether to me? You're going to pay $100,000 times 5, isn't it? You're going to pay $100,000 times 5. You're going to pay $500,000, isn't it? Right? So can we do debit your assets $500,000, right of use, and credit your liability $500,000? That's not correct, because $500,000 is your nominal cash flows that needs to be discounted. So you need to come up with year 1, year 2, year 3, year 4, year 5. You have your cash flows. What would be your right of use assets and your lease liability is discounted cash flows. So basically you have in year 1, you got to pay 100,000. Year 2, you pay another 100,000. Year 3, another 100,000. You do the same thing for 5 years. How are you going to discount it? And what is the discount rate are you going to use in order to discount them? And you remember, discounting is not new in IFRS 16. It's been there everywhere in accounting because of time value of money. Anything that you are going to receive or anything that you got to pay in more than one accounting period, when the time value of money becomes material, that needs to be discounted, and you need to use the present value concept. So it's nothing new in IFRS 16. You got to discount those cash flows, and how to determine the discount rate. That's going to be the challenge. There are two options available. One is the interest rate implicit in the lease, which is the IRR of your cash flows, right? So now how do you calculate the IRR? You simply enter the cash flows of your asset in an Excel spreadsheet and say equals IRR. That's going to give you the IRR, right? IRR is the discount rate at which your NPV, net present value of your asset, becomes 0, isn't it? Which means your fair value of your asset today. What is the meaning of fair value of your asset? Is, let's say, $100,000. You can buy the asset for $300,000, right? $300,000 is the fair value of your asset, and then you're going to pay $500,000, isn't it? Let's look at the same example. You have a fair value of your asset. I'm bringing in a new term now, fair value of the asset. When? In year 0. What does that mean? If you are paying the asset, if you are paying outright cash and buying this asset in the market, you're going to pay $300,000. But then why would you pay $500,000? Because you don't have money to buy this asset, so you're paying an interest of $200,000. So when you say interest rate implicit in the lease, we're actually looking at what is the discount rate if you use that will make 300,000 equals to 500,000. Basically, you have your fair value of your asset, which is 300,000, and your total gross cash flows is 500,000. So what is the discount rate that you must use in order to get this sorted? So let's open up an Excel sheet here and see how this works. Using my simple example, which I spoke about now, you'll see how this works quickly. I'm going to start sharing my Excel spreadsheet here. Here you go. Make sure that you are able to see. Can you see my Excel spreadsheet? Are you guys there? Can you see? Can you see? Okay, super. Right. So now this is what it is. I mean, look at my example. I said in year 0, you can buy the asset for $300,000, isn't it? You can pay money and buy an asset. And so let's say $300,000. Oh, you know, in year, I said the lease is for 5 years. So year 1, year 2, you go all the way up to year 5. You got year 5, yeah. And then how much are you going to pay? You're going to pay $100,000 each, right? So I mean, this is something you need to understand. It's basic, but sometimes when you do an example, it gets registered into your mind. And that's one of the reasons I'm trying to do this. I'm sure most of you know this, right? So you have $500,000 and this is $300,000. Let's do an IRR. Say IRR equals, and select these cash flows and see what is the discount rate. Okay, you see the discount rate here. The discount rate is actually 19.86%, right? So that is the discount rate embedded into this calculation. If you see, so what does that mean? If you are using this as a discount rate, if you discount these cash flows, you are going to get net present value of 0. What does it mean? Let's use discount rate of this. So I'm going to identify the discount factors. 1 divided by 1 plus 19.86 to the power of 1. Right, so I'm trying to identify the discount factors here. So this is how it's going to be. So it's going to be 5 years. So let's see how this works. Right, so let's drag this formula down so we get all your discount factors coming up. Sorry about that. Should have been a dollar sign here. There you go. And drag them out. So this is basically your discount factors. Let's see what I'm doing. So I multiply 100,000 by the discount factors. So this is your discount factor and this is your present value. So you multiply them and then you drag all the way down. And then let's do a sum. It would be interesting to see the answer here. You see what it is? You see $300,000 and that is this $300,000. So this is exactly what I'm trying to tell you. This is your fair value of your asset. So which is, if you pay cash and buy the asset, how much you need to pay? But $300,000. But are you doing that? No, you're paying $500,000 over 5 years to the lessor because you don't have money to pay $300,000 now. But what is the interest rate embedded into your calculation, which is IRR, which I'm trying to calculate and recheck whether it makes sense. So this is what I'm saying. What discount rate equates this and this? Fair value of the asset and present value of the lease obligations. And that is going to give you 19.86 is the discount rate. And that is what this slide is all about. So if you see, that's what we say. But remember, in case if you are not able to use your interest rate implicit in the lease, right? One option is incremental borrowing rate. You can make use of your incremental borrowing rate. What is the meaning of incremental borrowing rate? If you are borrowing money from a bank term loan for a specific maturity, which is similar to that of the lease maturity, what is the interest rate that you're going to pay to take additional loan, to raise additional financing, and that becomes your incremental borrowing rate. So either this or this, right, needs to be used. But for a certain type of leases where you know, you are using the asset or pretty much for the whole economic life of the asset, then I would think the best rate to use is the interest rate implicit in the lease. But when you're talking about I mean, any other type of leases, short-term leases like 3 years, 5 years, when the useful life of the asset is like much more, I have seen companies mostly using incremental borrowing rates. So it depends on which is the more appropriate rate to use. I mean, if anybody have any questions on this particular topic, please raise it up. at this point in time. If I'm not answering any questions that you have asked so far, I'm going to definitely take it up during the Q&A session, right? So moving down, you're going to look at a question and see how this is done practically. So here you go. So we'll have a short break in about, 20 minutes, 25 minutes time to refresh ourselves before we get into the most important part of the standards, lease modifications and rental rebates and concessions, right? So we get our basics sorted out before the break and understand what's happening to financial statements, leases and things like that. So we are all ready to go and talk about some advanced aspects on the standards, lease modifications and things like that. Right, so let's look at this initial measurement of a lease liability. My illustration here talks about or assumes the rental payments are made in arrears, right? But there are also situations where payments can be in advance, meaning that the first payment is made at the beginning of the year and the second payment is made is the beginning of the next year. So then the illustrations, the answers could be slightly different. How you do that could be different, but we focus on payment in arrears because that's the most popular thing that happens. So let's look at this question and understand how this happens. And please raise up any questions if you have on this particular calculation or anything else. Yeah, so look at this. XPLC enters into a lease. The following information is relevant. XPLC must pay 5 annual rentals, $100,000 in arrears. XPLC must also guarantee the residual value of the asset at the end of the lease term, $40,000. XPLC incurs initial direct cost of $5,000. Right, now let's look at what's happening here. Let's try to understand what is the rent schedule or rental cash flows. On this, you have 1 to 5 years, you have $100,000 needs to be paid to the lessee, and then the 5th year there is a $40,000, a guaranteed residual value. This is basically the scrap value, if you want to understand, or the salvage value, whatever you call it, residual value. Right, $40,000 at the end of year 5 is $40,000, which is the value of the asset at the end of year 5, and $100,000 is what you got to pay to your lessor over the next 5 years. So you discount them. 3.993 is your cumulative discount factor because the cash flows are the same. So we are using cumulative discount factor 399,271 and then 27. So the total present value of your liability is 426,494. So this is going to be the value of your asset and the liability, right? So how that's going to happen, you're going to have, if you want to see that quickly, $100,000 and $40,000. So let me go back to the Excel spreadsheet. How this happens is basically, let's say year 1 to year 4 you have, and then year 1, year 2 to year 5. So what happens for 5 years? You have, how much do you have in year 1? 100,000 for 100,000 each year. Okay, so how do you identify the cash flows here? If you go back, hope you are able to see my Excel sheets now. Right, so you have $100,000 for each of the years, drag them up, but at the end of year 5 it will be 140,000 because there is a guaranteed residual value of the asset, and the 8% is your discount rate, and then these are the number of years that you are going to have, and then your discount rate is 8%, isn't it? So 8% is going to be your discount rate. So that's what your discount factor is going to be. Your formula to discount cash flows: 1 plus 0.08 to the power of 1, and dollar sign here, drag all the way. Let's look at whether our numbers are making sense. So then you have the present value, this times this, drag them all the way down, and then that's going to be the sum of this. Let's see how it works. So you have 426, 494. So what I did, I discounted the cash flow using 8%, and my answer is 426, 494. Let's double check if the figures are the same, because this is a calculation shortcut. So I wanted to show you how that is done. So 426, 494. So that's going to be the first thing that you're going to show. You're going to debit your right of use assets. You're going to bring an asset in your balance sheet, which is not an asset that you own, but it's your rights of use. And you are creating a lease liability, 426, 494. And then what's happening then? You have your right of use assets. What is this? So it's something very interesting happening here. Can you see? XPLC incurs an initial direct cost of $5,000. So meaning that if the company is incurring some expenses relating to the asset, right? Some installation cost or transport cost, which are directly attributable to the assets and which qualify as cost as per non-current assets, and it is a capex that needs to be capitalized with the right of use assets. So you have a right of use assets 426, 494, which is the present value of your lease liabilities, plus you have the initial direct cost, which is $5,000. So your total assets value will be 431, 491, but your liability will be 426, 494. So now what are you going to do with regard to assets? Can we talk about what are you guys going to do with the assets? What are you going to do once you have created an asset in your balance sheet? What are you going to do? You're going to depreciate them. That is exactly right, Niresh. You're going to depreciate them. Oh yeah, obviously that's the very good way of saying is that from Aruna. You say you depreciate if you want to revalue them, if you're following revaluation approach, and test the asset for impairment as per IAS 36, impairment of assets. That's a fabulous answer, right? So that's what you say. That's exactly what he has responded to me, which I'll copy paste so that people can see. Right, so now, so what's happening here? 431, 494. So how do I calculate the depreciation here? 431, 494, and the lease period is 5 years. Is that right? Is it a 5-year lease? Yes. So you're going to divide that by 5 years. But remember, there is a salvage value. So basically, 431, 494 minus your salvage value, $40,000 divided by 5 is going to be your depreciation. Let's look at it, slide 21. Look at this. 426 plus the initial direct cost and 431 minus the salvage value, 391, 494 divided by 5 years. Remember, the depreciation rate should be based on the lower of lease period and useful life of the assets, and most likely the lease period would be shorter. So you use the lease period 5 years. So your depreciation is going to be 78,299. This is the charge that's going to go to P&L every year in terms of depreciation, and your asset will continue to be depreciated in your balance sheet. So that's what happens in IAS 16. So this is IAS 16 cost model. Obviously, if you do revalue them, it happens based on IAS 16, where the revaluation gains are taken to revaluation reserves. If you use IAS 40, the gain or losses on the fair value changes are taken to income statement. Right. Right now, okay, this is again another question that I've come up, which is linked to a previous point that we discussed from Prasanna, which I'm going to copy that and paste it for everybody. Look at this question. If the lease is annually renewable, how can you determine the useful life with confidence? So what you typically do is when you are using your present value estimate of your lease liability and rights of use. So you estimated a number of years in which you are going to use your asset, right? So you are going to use exactly the same number of years that you used in your present value calculation as the lease period in the calculation of depreciation. So that's exactly what you need to do. Okay, there's another question. Residual value has taken at net present value. So why did you deduct the cash value for depreciation calculation instead of net present value? Now, okay, that's the question is basically residual value has taken. Okay, I agree with you. Nandasri on that. You know, this is what IAS 16 says. They don't really talk about scrap value, discounting that. Maybe because what I believe is that scrap value probably it's a fraction of your initial value. So discounting there would actually introduce much more complexities, but if you want to discount your residual value, you know, you are always okay to do that. But I think 426 in this case, in here we are deducting, so the residual amount that you are deducting. Okay, that's an interesting question that you have raised. Is that 426, 494 includes a $40,000, which is a discounted figure. So that is not included in the 426, 494. And that's exactly what you mean. Okay, I get what you mean, Nandasri. That's a great spot. I agree with you on that. Right. So basically, his question is that this 40,000 is an interesting question from Nandasri, which I will copy paste for people to understand, right? So basically, when you look at the residual value, which we are reducing from this, is $40,000. But this is not the $40,000 that is part of your 426, 494, isn't it? That is the discounted value. So when you are depreciating that, you need to depreciate them. But this is as per IAS 16, right? So you have over 5 years, you depreciate them, and the depreciation is going to be 78,299, right? So that's what happens to your assets, right? So again, let's talk about a little bit on your useful life. When the asset is depreciated over the lower of useful life and the lease period, whichever is lower. So that's what we use as a lease period, and amortize them over a period of the lease period or useful life, whichever is lower. Okay, this is actually going to show how your liability is going to work, right? We already looked at how your asset is going to behave. It's going to get depreciated, tested for impairment, or revalued depending on what method that you are using. And now we're going to talk about liability. So when you are talking about liability, we are going to amortize the liability. And how we are going to do that, I think it's better if you do that in the Excel. Let's see how that happens. I'm going to go back to the Excel and show you quickly how your Excel. So this is going to be your 426, 494, which is going to be your initial liability. So let's say year 0. You have a liability of in year 0. Hope you're able to see my Excel. Can you see my Excel spreadsheet now? You're going to have year 1 to year 5 again. You know, this is year 0 at the beginning. You have a lease liability, which is 426, 494. Isn't it? Are you seeing my? Okay, great. Hope you are seeing my Excel now. Some people can't see my Excel. Are you able to see? Okay, great. So you have, and then how much are you going to pay? You're going to pay $100,000, isn't it? You're going to pay $100,000 each year. And on the $100,000, and how much is going to be your interest? This is your lease payment, isn't it? This is going to be your lease payment. And the interest rate that you have to use here is the 8%. So let's identify the 8% interest. How much that's going to be is basically 426,494 times 8% is 34,1919. So this is going to be your interest, and then you have your principal. That's going to be 100,000 minus 34,120. That's going to be 65,880. So your closing liability in the balance sheet is going to be 426 minus 65,880. So the idea is that at the end of the first year, out of the total cash flow of 100,000, 34,000 is interest, and the rest of it is principal repayment. So this is your liability at the end of year one. So year one. And then we become year two beginning. This is going to be your year two beginning. So your closing liability becomes your opening liability, isn't it? And then again, you are going to pay another $100,000. So on that $100,000, so what happens now? You have again an interest, which I'm going to drag this down for up to 5 years. So you have 28, and then this is your principal payment, and then your closing liability will be opening liability minus the principal repayment. Because what you do is in each of the years, when you make the rental payment, you're going to debit income statement 34,120 and debit the liability 65,880 and credit cash or bank $100,000. So that's exactly what you do every year. And then what happens here for each of the years? So this is going to be year 3 beginning, and then you have year 4 beginning, and then you have year 5 beginning. What happens? So now what's going to happen here is this. Year 1, 2, 3, 4, 5. And then what happens here? So in the year 3, you make another $100,000. Drag this all the way down. So this is what you do. So basically, this is the interest and the principal repayment. And then what happens at the end of year 5? So look at this. This is exactly what's happening. You see 100,000 payment is being made every year. Your liability is not becoming 40,000 at the end of the year. It's not becoming 0 because there is a residual value, and that's why your liability is at the end of year 140,000. So that's exactly what it is. So when you do this, it's going to become $40,000. So at the end of year 5, what's going to happen? The lessee is going to return the asset to the lessor. So that's what is going to happen. So this is how the discounting works. So I'm going to go all the way back to my slides now. So you see what happens. But if you're going to take, the thing is this, if you're going to take 140,000 lease payment here, then you're going to get a 0. So either way, if you take 100,000, then you're going to have 40,000. The asset needs to be returned so that the asset will be de-recognized. So if not, you put 140,000 here, it's going to become a 0 lease liability. So I'm going to go back. Before that, I want to tell you something. In terms of splitting your 360,000 into current and non-current liability component, your 360,614 would be the total liability at the end of year 1. On that, the current liability is going to be 71,151, where the principal repayable next year and the remaining portion 289,463 would be the non-current liability. So at the end of year 1, total liability is 366,114. No current liability which needs to be paid in the next year. Don't take 100,000 because 100,000 includes interest. and this only includes principal. So you take only 71,151 and the balancing figure will be non-current liability. So I'm just going to go back now to my slides and how exactly this is done. Here you could see this is exactly done. You need to split into lease liability into current and non-current liabilities. And so 71,151 is your current liability, which needs to be paid next year, and the balance would be non-current liability as we show in the Excel spreadsheet. So we kind of done with how to recognize the asset and how to recognize the liability and all the basic things. And before we go on to break, let's talk about this. This is, for me, is the most important slide in the lessee accounting standard. The next 3 slides, pay attention to these slides from an analytical perspective. When IFRS 16 is introduced, right, what do you think is going to be a major change taking place in the books of lessees? In the balance sheet. In the balance sheet, what's going to happen? Can we guys talk about it? What do you guys think is going to happen in each of them? Are you guys there? Are you guys there? Yes. So can you tell me what's going to happen to the balance sheet of IFRS 16 implementation of IFRS 16? What's going to happen to the balance sheet of the lessees? Remember, we are still talking about lessee, isn't it? So what happens to the lessee accounting treatment? In the balance sheet is going to have what? What is the major change that's going to happen in the balance sheet of the lessee? This is going to be the summary of all what we discussed. Okay, that is exactly right. So you're going to have large amount of assets and liabilities recognized. Yes, Niresh, lease liability should be shown and right of assets should be shown in the balance sheet. That's exactly right. So the company is going to have large amount of assets and liabilities in their balance sheet. That's exactly right. And then will particularly affect. Okay, look at this. Would you agree if I say the new accounting standard, IFRS 16, will affect both companies who previously had operating leases and finance leases? Would you agree with me? Let me repeat myself. Do you think the IFRS 16 implementation would affect two different companies have equal amount of leases, but one having large amount of finance leases and the other one is having large amount of operating leases? Which company you think is going to be most impacted by IFRS 16 implications? Which company? The company with the large amount of operating leases or the company with the finance leases? That's exactly right. That is exactly right. It is right. Companies having large amount of operating leases, that's exactly right, are going to be impacted. Why? Because when it comes to finance leases, you anyway had assets and liabilities, right? So the company with a large amount of operating leases is actually now have to recognize a large amount of assets and liabilities in their balance sheet. So they are going to be the large impacted ones. The finance leases, they anyway had finance leases, they had assets and liabilities, not much of an impact. But you need to reclassify your assets from your property, plant and equipment into right of use assets, right? So going further down, your loan covenants may be breached and needs to be now renegotiated. I mean, what are these loan covenants? These are the maximum debt to equity ratios or any other covenants imposed by the banks on companies when they are providing credit facilities. If gearing ratio is something which is going to significantly increase as a result of higher liabilities in the balance sheet, so what's going to happen is that your covenants may be at breach. Maybe you got to renegotiate your covenants with, or you've got to maybe renegotiate or refinance your loans with the banks with the introduction of the new standard. Okay, what happens on the income statement? This is a very interesting question. Of course, the balance sheet question can be very easily answered. So what happens on the income statement? Anyone wants to talk about it? So what happens to the income statement? Okay, that's a very good point. What Nandasri is pointing out is that when you try to show a larger amount of return on assets, investors in the stock market think, okay, there is additional assets in the company's balance sheet, and they think the share price now should go up because there are more assets coming up. I think that's a great point, Nandasri. I think definitely this is kind of causing mispricing of securities in the stock market, because the companies always had these assets and they were using these assets anyway. So it is just that they were off the balance sheet, and now you are bringing them on the balance sheet. So it's not a new asset created for the company. So it is just a change in the presentation of financial statement, isn't it? So that kind of, I think there needs to be, CSC definitely needs to play a key role here, educating investors on these type of things happening. If that happens, I think, there should be some more discipline coming into the markets. Even when it comes to liabilities, I don't think investors should be selling the stocks, because these liabilities were always there. It is just that they are bringing it back into your balance sheet. So your share prices, which was there already factored in these assets and liabilities the companies have had. Obviously, that's a different thinking. That's what I think it should be viewed at. All right. So moving further down, what happens to your income statement? Income statement, guys. What happens? Previously, you had an operating lease rental in the OPEX, and now you're going to have, that's exactly right, Aisha. It's going to go into income statement, depreciation and interest. So your OPEX is going to go down, depreciation is going to go up, and interest is going to go up. But remember, over a period of time, there is no impact on the P&L, because your depreciation and interest is going to be actually equal to the operating lease rental, let's say over a period of 5 years, if the lease period is 5 years, isn't it? But when it comes to new standard, the P&L, the expenses will be front loaded. What do you mean by that? I like this statement here. Lease expenses will be front loaded. Why is that? Because you are going to have, if you understand, the interest, we see the interest is at the beginning, it's very high and gradually drops down. So although you're going to show almost similar amount of figures in the income statement over a period of time, at the beginning, because your interest is going to be more, because your capital outstanding is high, your lease payments are going to be front loaded in the income statement. The pattern of expenses changing and the impact on operating margin, but it's just a classification change. But you will see expenses front loaded at the beginning, profits come down and gradually going up later. So that's the most important thing to remember. Okay, what happens on the cash flow statement? That is again an interesting point to discuss. So operating lease payments are part of cash flows from operating activities. So this is going to be moved out of operating activities and split into two: interest expense and liability repayment, principal repayment. So interest expense can either be on operating activities or financing activities, but principal repayments must be a financing outflow from financing activities in the cash flow statement. Again, you see a shift from operating activities into financing activities taking place with the introduction of IFRS 16. But overall cash flow for the period doesn't change, because you are anyway not changing the amount that you are paying, isn't it? It's a change from operating cash flows to financing cash flows. The impact would be more, impact is more when it comes to if you are charging interest to as interest and principal both in your financing activities, you are going to have more. So that's an interesting question again, Ashad. Interest in suspend accounts, no, I mean interest in suspense account discontinued with the usage of present value concept in the world of accounting, meaning that your liability that you show in your balance sheet is excluding the interest because it is the present value, it is the principal value, so there is no interest in suspense. You don't talk about it. You talk about it when your principal includes interest. So IFRS 16 does not talk about interest in suspense. Again, a great question. And then look at the ratio impact. Debt to equity ratio is going to be more, and there is a possibility of a covenant breach, reduced asset turnover ratio and return of assets because assets are there in the balance sheet now. True reflection of financial statements. Okay, right. So there's a question from Nilam. What about sum of digit method? And remember, sum of digit method, reducing balance method, or straight line method are different methods of depreciation. They are permitted as per accounting standards, right? So if that is what you mean to ask. The true reflection of financial statements, isn't it? Now, previously, the assets were there, the liabilities were there. It is just that they were kept off the balance sheet. Now you're bringing them on the balance sheet. So better presentation of financial statements. The impact on valuations. This is something very important. This is again a question what a while ago Mr. Nandasri was pointing out, is that what do you think is the impact of valuation? I mean, for me, if I think from a valuation perspective, you know, as an analyst, whether you are a credit analyst or you are an analyst working for a bank, or you are an equity analyst, when you're doing your equity valuations, or you're doing your credit valuation as a credit analyst, whatever you do, I would definitely think you would have already capitalized the assets and liabilities in your balance sheet before you value the company, isn't it? I mean, remember, I'm not sure if you guys know, if you look at in the past in IAS 17 or the equivalent US GAAP, there was a disclosure requirements which talks about the company needs to show their operating lease commitments, what needs to be paid in the future over the lease period needs to be broken down into various years, and you need to have a breakdown shown in your as a disclosure requirement when it comes to operating leases in IAS 17. So now what we used to do previously when I was an equity analyst years before, I think it was somewhere in 2006, 7, 5, 6, 7, during that period, when IFRS 16 was not there, we used to discount these cash flows in the disclosures and add them to the assets and liabilities when you calculated gearing, when you valued this company. So everything we took care of it, right? But it's just that now they are all coming on the balance sheet. You don't need to work around with all these disclosures. But technically speaking, I don't really think there should be a change in your valuation of companies, unless if the analysts were not doing their job correctly in the past. They were not being aware of that there are these assets and liabilities in the balance sheet. But if you, as in the analysts were rational previously, and then obviously your valuation included operating leases in their balance sheet, now also it includes. So I don't think there should be any reason to change, unless if you have not considered, then you will have to start considering now. Hope that makes sense to you and you guys agree with my opinion here. You can share obviously your views as well. No analysis adjustments are required on financial statement, ratios and valuations, as the balance sheet now correctly reflects your assets and liabilities. So that's basically, so this is kind of your format. If you understand here, you have IAS 17, you have your revenue, cost of sales, and in IAS 17, you had operating lease rentals, and then you had your EBITDA. and then you had your depreciation and amortization, and then you had nothing. You never had depreciation, you never had finance expenses. Now you have depreciation on right of use assets, and then you have interest expense. You don't have operating lease expenses. So that's the end of it, and we are going to go for a break in 2 minutes. If you can give me 2 minutes, I'm going to show you something very interesting. Then we go for a 10 minutes break before we come back. So this is going to be something very interesting. I'm going to show you. I'm going to start sharing my screen. There you go. I'm going to show you how this practically is done, this particular accounting standard. So this is basically 2019 financial statements of a listed company in Qatar, which is called Ooredoo, the largest telecom operator in the region. Let's look at their financial statements and see the implications of the new accounting standard. There you go. I managed to open it. I'm going to start sharing the screen. Are you able to see my screen? Are you guys there? You guys able to see my screen? Just made it bigger now. Are we there? All right, super. Let's go down and see what's happening here. This is Ooredoo. Got a very big balance sheet. You can see what's happening in their balance sheet and their income statement. So, I mean, look at first your balance sheet. Okay, it's easy to first look at balance sheet. Let's finish off the balance sheet. What are the key changes are you guys seeing in this balance sheet? The key changes that you see here, what do you see? What do you guys see? A key change. There was no restatement needed by the standard board on this. So the prior year figures were not restated, if you see. So you can clearly see the difference. What's happening to your rights of use assets? You have 6 billion riyals of assets and you had 0 assets here. And then you see on the liability side, you're going to see the major liabilities. Very similar figures. Look at the liabilities. You have a lease liability, new liability coming up on the non-current 5.6 billion riyals, and then on the current liabilities that you have 956, adding together close to the right of use assets. So these are the operating leases which were classified into on the balance sheet with the new standard coming into effect on 1st Jan 2019. So this is on the balance sheet. Very clear. Now we are going to the income statement. Can you guys tell me where do you see the major differences here on the income statement? I would like to hear from you guys now because it's a bit tricky here, isn't it? It's not as easy as your balance sheet. So where do you see? What are your key observations in this particular income statement which we are seeing here? What do you see in the income statement at this point in time? In this particular slide, what are your key observations? Can make it slightly bigger. Okay, that's a good point, Niresh. Spot on. Reduction in the OPEX. There is a 11.8 billion has become 11 billion. So there's a reduction of 800,000 riyals. That's a good observation. 800 million riyals, sorry, not 800,000. Right. So anything else that you see? Anything else that you guys are seeing on other expenses? Okay, depreciation increase. That's exactly right, Anthony. Increase in the depreciation, obviously you are right. 8 billion to 8.5. And then you got what else? You got what is the last item? What do you see? Increase in the finance cost. Yes, that's exactly right, guys. Increase in the finance cost from 1.7 billion to 2 billion. Right, so the changes have been reflected here. And then let's look at what is this OPEX reduction. If you go to note 5, you can see where the OPEX is actually falling down, in which line the OPEX is dropping. So that's exactly what's happening. Look at the OPEX here. Where do you see the major reductions? You see rentals and utilities. 1.7 billion has become 1.1, which was previously the operating leases which were expensed are now removed. So that's what it is. So that's the end of this practical application, how it is reflected in the financial statements to understand what's happening. So we're going to have an interesting second half on reassessment and modifications starting from slide 27. So I'm going to now, the time at this point in time is 11 p.m. GMT, because there are various people from different time zones I'm talking about in GMT. So I'm going to see you in 10 minutes. It's 1:11 GMT. I'm going to see you at 1:21 p.m. GMT. All right. Thank you, guys. I'll see you shortly. So welcome back, everyone, after the break. So now one of the key questions that's been raised from multiple participants is to provide additional guidance on the use of determining the term of the lease when it comes to renewable lease contracts. So when you talk about renewable lease contracts, you need to consider a wide range of factors in identifying the lease terms. So number one, you need to look at if there is any non-cancelable lease period, right? In most of the contracts, probably you will have a non-cancelable lease period. For example, you say 5 years, and then the non-cancelable lease period is 3 years. So within the first 3 years, the lease cannot be cancelled without incurring a substantial penalty. So that could be one. And then there could be notice period. Maybe you will have to provide 1 year notice or 6 months notice. So the notice period also needs to be taken into account in your lease term. And then obviously the penalties of breaching the contract early also needs to be part of your cash flows as well. And obviously the management used to have to make use of their historical evidences in terms of determining the correct the terms. And I believe most of the organizations are now rewriting their lease contracts with their lessors, so that all this information which previously were never included in your leases are now becoming more apparent in your lease contracts, like non-cancelable period, penalties and fines, and the notice period, and guaranteed receivable amount. And a lot of information will have to be presented in your lease contract, so that makes life easy for accountants and management to estimate the right number of lease terms to be used in your calculation. And in most of the companies that I have seen where they had a lease period where with the lessor, the annual renewable lease contracts with for their rental payments, most companies, they went back to the lessor and amended the lease contract to include the basic data needed to be captured when you are creating an asset and liabilities in your balance sheet. And remember, some of the key things that you need to look at in order to design the lease contract are the non-cancelable periods, the notice period, penalty for cancelling the contract early, and historically how long you have been using this contract before cancelling. So there are a lot of number of issues that needs to be dealt with before identifying the lease contract, and as we know, that is something which is very, very important. Right, so let's move into the second half, where we are going to talk about the lease modifications. And there's a lot of requests to share the recording and the presentation slides. So I'm anyway going to do that after the webinar is over. I'm going to send it to you, the presentation slides, as well as the recordings as well, right? So, so to make use of them in the future, if you want to have a look at them again, right? So now, if you look at the second half today, where we're going into, it's going to be something very important to talk about reassessment and modification, right? So what do you mean by reassessment and modification? There are three things that you need to know. What is remeasuring the lease liability? And the second thing is lease modifications, accounting for lease modification. So you need to first understand what is the difference between a remeasurement and a modification in a lease. Now, for example, if there are any changes in the scope of the lease, right, during the lease period, which was part of the original lease contract, is not a modification. For example, in a lease agreement, there is an option to extend the lease period by 2 more additional years after the end of the lease period. So at the end of the lease period now, earlier the company was not renewing, they were not planning to extend it, but now they decided to extend it by 2 more years. Remember, this is not a modification. Why? Because the option to extend the lease contract was part of your original lease contract. So when you talk about modification in a lease, remember, any changes in your lease contract, right, whether you are increasing the scope of the contract or decreasing the scope of the contract, increasing the lease rentals, decreasing the lease rentals, or increasing the contract period to use the asset for additional number of years, whatever that you do, whatever that you use, remember, you need to assess, is this part of your original lease contract terms and conditions, right? If you are acting according to your original lease conditions, right, and if you are for example, if as per the original lease contract, you kind of have an option to buy the asset at the end of the lease period, and earlier you were not planning to buy them, and now suddenly you decided to buy them halfway through the lease, then this is actually not a modification. Why? Because the option to purchase the asset at the end of the lease period was part of your original lease terms and contracts. It's very important to see, look at this. Circumstances might change over the life of the lease, leading to a change in the lease payment. So your lease payments are changing, and remember, changes in the lease payments is not always a modification. It is important for you to decide if these changes are part of your original lease contracts, if they are there or it is not there. So at this point in time, let's focus on remeasurement, but not a modification. We are talking about remeasurement, which are not modifications as per the standard. So there are 2 changes. I'm going to explain you using an example, and before that, look at this. This is a summary that you need to know, right? There can be 2 major items which can change. One is the change in the lease payments, whether it could be change in the guaranteed residual value, or there can be changes in your lease payments as a result of your annual rent review, right? So in this case, you need to now identify the revised cash flows, discount them, remember, using the original discount rate that you use at the commencement of the lease. So this is exactly what you do when you are using remeasuring changes in your future cash flows. Now, using a revised discount rate, when would you use a revised discount rate to discount your cash flow? Is when there are changes in your lease term and changes in the assessment of an option to purchase the underlying asset. This is basically you are going to use a revised discount rate to discount the cash flow. So this is a very important slide to understand. Remember, both of these are not modifications because we are talking about changes taking place in the lease period and your lease payments which were part of the terms and conditions in your previous standard. So that's exactly what we are talking about. And then going back to slide 29, now there's an example to look at how to account for remeasurement. A simple example, we'll quickly look at them before we go into the modification. So the next topic is the modification. So if you look at this, what's this example? So pay careful attention to this example. So this is going to clearly tell you how to account for remeasurement. And remember, it's still not a modification because we are looking at examples where the changes are happening which are within the scope of original leases as well, right? Look at this example. The balance in experiences at the end of year 4 before the remeasurement of the liability. So look at this. This is an existing example. You remember the previous example that we spoke about, the asset with a 5-year useful life. The value of your asset is 426,494. Hope you remember the example. If you go all the way back here, okay, this is the example I'm talking about. You actually say the 426,494 is the value of the asset. And the useful life of the asset or the lease period, I think the right term to use is the lease period, was 5 years. And now what's happening? Look at this. At the end of year 4, right, they are actually now thinking to extend the lease for another 3 years. Now, is this a modification or a measurement? And remember, this extension clause was there at the original lease contract. Is this a lease modification or no? Now they are planning to extend the lease period. They were not planning to do that previously, but there was an option to do that in your lease contract. And previously, it was not taken in the calculation of your lease liability because the management did not believe that they would extend it. But now, halfway through the lease at the end of 4 years, now they have decided, okay, we are going to extend the lease for 3 more years at the end of year 5. So that's exactly what they are going to do. So is this a lease modification? Obviously no, because this extension clause was there in your lease agreement. So let's see what's happening. At the end of year 4, what is the carrying value of your liability? So in your balance sheet, you've got a liability of 129,630. And what is the value of your asset? You think about it, what happens to your assets value? 431,494, and you know the depreciation we calculated about 78,000 a year using 5-year useful life, and then you've got a depreciation of 78,000, so that's for 4 years. So now this is the accumulated depreciation for 4 years. So this is the carrying value of your assets, right? So you've got a carrying value of your asset, and then you've got a carrying value of your liability, 129, 118. This clearly tells you your assets behave differently and liabilities behave differently in your balance sheet. Assets get amortized and liabilities, they behave as the time value of money, isn't it? So that's where you have 118. Now what's happening? We are identifying the revised cash flows. It's important. Pay attention here. So what's happening? You are having year 5 cash flows, which is the as per the previous lease terms, $100,000. These are the extension period. Pay attention here. Year 1, 110,000. 110,000, 110,000. So they agree to increase the lease payments by $10,000 to use the asset for 3 more additional years. So what's happening? You're discounting them using a discount rate of 9%. Okay, now look at it. Why is this 9%? It's a revised discount rate. It is not the original discount rate because what is changing? What is the change here? why are we changing the discount rate? Can anyone answer this question? Why are we using a different discount rate of 9% here instead of using a discount rate of 8%? Okay, that's exactly right, Anton. The lease payment is changing means it's only original discount rate. I think what's happening is that the lease term has changed. That's exactly right, Aruna. That's why we are using 9% as a discount rate, not 8%. So we are discounting all the cash flows here using 9%, and you get 347,195. And now it is very straightforward, isn't it? This is your revised present value of your lease obligations, and then you go back and identify what is the current liability before the adjustment. Go back and see in your schedule. I'm sure you can create this schedule using Excel on your own. You got 129,630 is your liability value before the lease. 118,299 is the asset value before the lease. So now what are you going to do? You're going to identify the liability adjustment. The new liability, which is the remeasured liability, is 347, and then you have the liability before the adjustment is 129. So you have a total remeasurement adjustment of 217,565. All right, and then this is achieved. So what you do, you are going to increase your liability and the asset both by the same amount. Remember, this is very important when it comes to remeasurement, right? You increase your assets and increase your liabilities by the same amount. You see, you're going to debit the right of use assets by 217,565, lease liability 217,565. So what's going to be your assets value? 118,299 was the carrying value before. You see the depreciated value 118,299. You are adding the revised liability value. So you remeasure the liability, identify the difference, add that to the asset as well. So you're going to debit your assets, credit your lease liability. So remember, remeasurement will have an asset and a liability which are offsetting each other, right? So that is super. So that's exactly what happens when it comes to this is basically that's exactly what we try to do. So basically look at the remeasuring the lease liabilities. So we're using 9%. So this is what happens. And so we know what exactly happening. So you see what's happening starting from year 5 until year 8. You got the new 347,195 and 9%. So you're going to calculate interest at 9%, which goes to your income statement. Your depreciation is going to be 335,864 divided by 4. Now there is no more salvage value. It is no longer relevant. That was at the original terms of the lease, isn't it? So you take your revised assets value, depreciate it by over 4 years. 4 years is the remaining lease term. You got 1 year of the past existing lease and 3 more additional years. So that's going to be 5 years. Sorry, 4 years altogether. And here you cancel out your liabilities here, right? So that's exactly what's happening in this case. So there is an interesting question here from Prasanna. Let's read that out. So I'm going to copy that and paste it for everybody. For all regional plantation companies, and the lease term and the land lease value is annually increased by the GDP deflator. So should we use a new discount rate? The problem is we had to use an annual incremental interest rate in the absence of implicit rate. So if you don't have an implicit rate, you're anyway going to use an incremental borrowing rate to discount your cash flows, isn't it? So in this case, if you are using an implicit interest rate, right, you would continue to use the implicit interest rate even if the lease value is annually increased, because that's going to be just an annual lease review, which was part of your original lease contract. And there, if you look at remeasurement, you will use original discount rate if there is no change in the number of years in the lease. You continue to use that information. So basically you can continue to use the original discount rate when it comes to changes in the lease payments, but not the lease term. So when your lease term is changing, and that is the time when you will look at your changing your discount rate, either implied implicit interest rate or the incremental borrowing rate at that point in time. If not, you continue to use the original discount rate as it is, whether it is incremental borrowing rate or an interest rate implicit on the lease. Right? So that's exactly what you do. And so this is basically what happens. So remember now, as we said, the previous examples that we have looked at so far does not take into account lease modifications. These were not lease modifications. The lease modifications, remember, changes in the scope of the lease or the consideration paid. The consideration is either going up or going down, or changes in the scope of the lease that was not part of your original lease. In that case, this is a lease modification. And let's look at how to account for lease modification. And before that, let's look at how to identify whether something is a lease modification or not a lease modification. I have a summary slide. I always kind of want to talk about the summary slide first, so give you a broader perspective to the audience before, and then we dive deep into some of the important examples. So look at this. In remodification, if you look at the summary, number one, it's not a lease modification, which means changes that are part of the original terms and conditions of the lease. So which means you would just remeasure your lease liability with a change in assets and liability, and the figures, the adjustment is going to be identical to assets and liabilities both, isn't it? So you're just going to debit your right of use assets or credit lease liability, or vice versa. If there is a reduction in the lease liability, maybe you are shortening the value of the lease, not extending it. So in that case, there's going to be a reduction in the right of use assets. There's going to be a reduction in the lease liability by an equal amount. So that is not a lease modification. What if it is a lease modification? Remember, lease modification has got two types, and there is one more type got added into it now, which I'm going to talk to you shortly. In the lease modification, we are going to say, okay, the lease modification is a separate lease. The lease modification can be accounted for as a separate lease. What does that mean? Is that the lease modification is giving you additional rights to use an underlying asset. So there's going to be an additional rights to use an underlying asset in the lease modification, which is going to be create a separate lease, right? And the next one, the lease modification is merely a change in the scope, whether you are extending the lease contract, reducing the lease contract, but it's not creating an additional rights to use additional assets, right? For example, let's say you have taken on lease a building, first 4 floors, as part of your lease contract, and now you are planning to add additional 2 floors. That means it is creating a separate lease because there is an additional rights to use an underlying asset. But if there is no additional assets, then it is just a lease modification. Changes are not part of the original lease terms of the asset. That is why it is a lease modification. It does not provide additional rights to use the underlying asset. Yeah, if it is creating, then it should be accounted for as a separate lease. Increase or decrease of scope, it could be either way. And lease liability to be remeasured using revised discount rate. Right? Change in the value of the right of use assets and gain or loss to the P&L. Remember, there's going to be a different value adjusted to assets and different value adjusted to liabilities Due to that, there is going to be a gain or loss recognized in the income statement, and that is how accounting wise a remeasurement becomes different from a modification. In a modification, there's going to be a P&L impact, because the value at which you're going to change your asset is different from the value at which you're going to change your liability, right? Let's look at an example and see how this is done. So this example first talks about whether this is a lease modification or not, right? So you know what is lease modification, and this is the first example you're going to talk about. So look at this. So look at this. XPLC leases a building, and before saying that, and then once we are done with this, we are going to talk about the most important topic for today for us is to talk about how to account for rental rebates and concessions. So that's going to be very important. XPLC leases a building for an initial period of 5 years with an option to extend the lease for a further 3 years. At the commencement date, XPLC concluded that it was not reasonably certain to exercise the option, so the lease term was determined to be 5 years. However, there was a clause to extend it. At the end of the 4th year, XPLC's circumstances have changed, and now they are reasonably certain that they will exercise the option to extend the lease. Okay, now you're going to tell me, is this a remeasurement or not? So what's happening? Let's try to understand. There was a remeasurement clause. There was a extension clause in the contract. Previously, they thought and they are not going to extend it, but now the management has decided to extend it by a couple of more years. Is this a lease modification or not? What do you guys think about it? Is this a lease modification? Is this a lease modification? No. The thing is this. Think about it. You had an original lease contract. In the original lease contract, you had a clause which says you can extend the lease by a couple of more years, 3 more years during the period of the lease. It is just that you did not believe that you would do so, but halfway through the lease, you have now decided you're going to make use of this lease period. You're going to make use of this option and you're going to exercise them. And remember, the extension was part of your original lease terms and contracts. So it is just a remeasurement. It is not a modification. Why it is not a modification? Because this extension clause, where is there? It is there in your original lease contract. So that is the most important thing that you guys need to remember here. It is not a lease modification, as it is change that was part of your original terms and conditions of the lease. Now, next example, look at this. XPLC leases a building for 5 years. At the end of the 4th year of the lease, XPLC's circumstances have changed and it has contracted with the lessor to extend the lease for further 3 years beyond the original terms of the lease. So in this example, the extension that's happening here was not part of your original terms of the lease. It is just that lessee and lessor negotiate halfway through the lease and they agree to use the asset. The lessor agrees to use lessee to use the asset for additional years. So in this case, the option was not there in the original contract. So it is a clear example of the lease modification because the change was not part of the original conditions of the lease. Right, now moving further down, examples that where the lease modification of the lease which is kind of creating a new lease, right? So basically the lease modification is creating a new lease, So that's going to be at this point in time. Just to make one announcement, because there was kind of a couple of questions raised here, is that on the CPD hours that are available, ACCA has agreed to provide 3 units of CPD for this webinar covering 3 hours. So we will be sending CPD confirmations, which you can use as a CPD evidence as part of your CPD development with ACCA, right? And then, I'll be sending out to the people who have participated in live throughout the 3-hour period, right? So based on so this is the instruction from ACCA is to send out the CPD confirmations to candidates who have been participants who have been participated throughout the 3 hours, right? So getting back to lease modifications is basically you got this is a lease modification. Now again, it's worth going back to the summary to see where we are in the right we are all in the same page. If you see, you have a lease, not a lease modification, it's a lease modification creating a separate lease, and the lease modification is not creating a separate lease. So those are the 2 additional things that you got to remember. So now I'm going to go back to lease modifications, which are creating additional assets. Look at this example, an interesting one. XPLC enters into a 6-year lease for 3 floors of an office block. At the end of year 4, XPLC and Lessor agree to amend the original lease for the remaining 2 years to include an additional floor in the same block. The increase in the lease payments is going to compensate with the based on the current market rate for the extra floor as adjusted for a discount to reflect cost saved by the lessor in renting, right? Analysis. So now we are going to try and understand what is this. The modification grants XPLC an additional rights to use the underlying asset, an extra flow, an increase in the consideration for the lease is going to compensate the increased usage. And remember, the increase in the consideration will be based on the market rates for the additional flow. If the lessor is going to give that flow to someone else, how much he's going to charge on a standalone basis for that particular flow is the same rent that he's going to charge from the lessee minus any cost savings happening due to transferring to the existing lessee rather than finding a new lessee to let out an additional flow. So in that case, it is going to give you an additional asset, and the price that is going to be charged is going to be standalone selling price of the asset. It is not going to take into account your existing lease, and they are not giving you a big discount because you are an existing customer. In this case, this modification is a separate lease from the original 6-year lease, right? So it needs to be accounted for as a separate lease. So XPLC must recognize a right of use asset and a lease liability relating to the additional flow. So you continue the existing one as it is and create an additional lease. Look at it. There are no adjustments in respect of the original lease of 3 floors as a result of this modification. This is very important point to remember. If you are talking about a lease modification where there is an additional asset is coming into the picture, you need to create a separate lease with the right of use assets and the liability. You do not change anything onto your existing lease assets and liabilities that you have in your balance sheet. So that's something very important for you to remember. That is lease modification when there is a new lease. Now, what are we going to now look at it is basically we are going to look at lease modification with reduction in scope, meaning that there's going to be no separate leases. Why there is no separate lease? Because there is no additional rights to use an additional assets like an additional flow in the previous example. So that's very important to look at it. Look at this example, what's going on here. XPLC enters into a 6-year lease for 3 floors of an office block at $100,000 per floor per annum payable in arrears. The interest rate implicit in the lease could not be readily determined. So if you can't determine, as we previously said, if you can't determine in the interest rate implicit on the lease, then you have to use the incremental borrowing rate, which is 5% here. The asset is written off on a straight line basis over the term of the asset. At the end of year 4, XPLC and the lessor agree to amend the original lease for the remaining 2 years to reduce the space to 2 floors only. So previously they have been using 3 floors and now they are going to only use for 2 floors, isn't it? They're going to only use for 2 floors. XPLC's incremental borrowing rate at the date of modification is 6%. Right. Now the question to you is this: is this a lease modification? Number 1. What do you think about it? Is this a lease modification? Yes or no? What do you think about it? Is this a lease modification? Yes, that's exactly right. The answer from Adnan, yes, it is a lease modification. Why is this a lease modification? Because the reduction in the scope was not part of the original lease agreement. In the original lease agreement, there was no option to reduce the number of floors, neither there was an option to increase the number of floors. So it is clearly a lease modification. But the next question is it giving you additional rights to use additional assets? Does it bring in an additional asset? No, it's not. So it is not creating a separate lease. It's not creating a separate lease as per lease modification. So this is just a scope in the change of your existing lease. So it needs to be accounted for as a modification, but not as a separate new lease contract. So I'm going to take you through quickly an example to show you how exactly this works. If you see what happens, look at this interesting example. I always like to look at numbers. The reasons to look at numbers is that gives you kind of a greater understanding about the theory that we are talking about. So it's becoming more practical into how we look at this. Right, so the accounting treatment, you have lease liability 1 to 6 years, you have a cash flow of $300,000. So this is your 1.52 to 800 was your lease liability measured at the beginning. At the beginning, when you say at the commencement of the lease, when you have to create a rights of use assets and a lease liability. So what this company would have done at that point in time, debit assets 1.5 million and credit lease liability 1.5 million. Now, at the end of 4 years, it is at the end of 4 years they decided to use only 2 floors, isn't it? At the end of 4 years, they decided to use only 2 floors. Earlier, they were using 3 floors, isn't it? So that's exactly what's happening. So it's very important, before you account for a lease modification, you need to understand what is your carrying value before the lease modification, isn't it? So look at it. Look at the asset. What is the carrying value of your asset? The carrying value of your asset is like you had an asset value 1522. So what's your asset value? 1522800. It was your asset value, and then basically divided by 6. Why would you divide it by 6? Because the lease period is 6 years, isn't it? So you're depreciating over 6 years times 4. Why times 4? Because 4 years have been completed, isn't it? So at the end of 4 years, your assets value is going to be 507,600. Why? Because what is going to be your annual depreciation? If you calculate it, your annual depreciation is 1522800 1522800 divided by 6. That's going to be 253,800 times 4. So times 4 is going to give you 1015200. So that's going to give you your minus the original value of your asset. That's going to give you 507,600, isn't it? So 1522800 minus 1015200 is what is going to give you 507,600, which is the carrying value of your asset at the end of year 4, just before the modification happened. Okay. Look at the carrying value of your liability, and you know how to construct your liability schedule, isn't it? So when you do the liability schedule, what is your carrying value of your liabilities is going to be basically at the end of 4 years, you had a carrying value of your liability. So what's going to happen? Your revised lease liability is going to be how many years more for you? You got 2 more years left for you. And what is going to be your revised cash flow? You are going to pay $300,000 for each of the years. So you're going to pay 300,000 for 550 year. You pay another 300,000 for 60 year. Look at it. Understand this is basically what's going to happen. So basically 300,000 is what you were paying because you were paying for three floors, isn't it? 3 floors. You were paying for 3 floors. So your value of your lease liability before your remeasurement or modification is 557,600 because that is for 3 floors for 2 years. Now lease term is not changing, but number of floors is changing. You got to now use only 2 floors, so you will only pay $200,000. So $200,000 for 2 years, discounting them at revised discount rate. Look at it, the revised discount rate is changing. 5% is your original discount rate and 6% is your revised discount rate, which is the incremental borrowing rate at the time of, this is the incremental borrowing rate at the time of your modification. So you're using 6%. So this is going to be your revised liability. So you have your revised assets, 507,600, your revised liability. This is your existing, this is your existing carrying value of your asset, existing carrying value of your liabilities, and this is your revised value of your liabilities. So what's happening to your liability? Liability is falling down from what to what? It's falling down from 507,600. It's becoming 366,600 because it's reducing because you're using 2 floors instead of 3 floors, isn't it? So what is the reduction in your liability? 507,600 minus 366,600 gives you 141. It's going to give you 190. Sorry, I made a mistake. 557,600 minus 366,600 is going to give you how much? 191,000 reduction in your liability. So what is going to happen to your assets in this case? What is your assets value prior to modification is 507,600. That is for 3 floors. So if you say 3 floors, so 1 floor, how much that's going to be? 507,600 divided by 3. That's going to be 169,200. So your revised assets is going to be 506. So what is going to go out? The rights of use is going to be reduced by 169,200 because your asset is going to go out. 1 floor is going to go out. So you see, you are debiting the lease liability by 191 and you are crediting the right of use assets only by 169. Why 169? You had an asset value 507,600. You divide it by 3 floors times 1 floor, which you are giving it back to the lessor. That is going to go out. That's going to get de-recognized. But you see there is a difference your liability is coming down more than the reduction in the asset. So there is an income for you. So you see lease liability debit, credit right of use assets, credit profit or loss 21,800. So there is no need for you to use the same figure for assets and liabilities. Your assets are measured differently, liability is remeasured differently, creating a gain or loss into your income statement, which is a very important point for you to remember when it comes to a lease modification. There is no separate lease, but there is a reduction or increase in the scope that was not part of your original lease agreement. So this is the summary now. Not a lease modification and lease modification with a separate lease, and lease modification change in the scope. Right, so this is exactly what you need to remember when it comes to modifications. And now moving on to slide 43, where we are going to specifically talk about how do we account for rental rebates and concessions as part of COVID-19, and a practical experience by IASB that was issued in May 2020 in order to support lessees who was already in trouble as a result of lockdowns caused by COVID-19. The businesses were closed, but you still had to pay leases, putting a lot of strain on cash flows of entities in various industries. Right, so as a support mechanism, governments induced or government forced lessors to provide rental concessions and rebates to companies, to lessees, or there are voluntary rental rebates were given by lessors to various lessees affected by COVID-19 and the resultant lockdown and the business closures. So at this point in time, there were this rental rebates and concessions were at historical high in the year 2020. How do we account for them? Is this part of modifications? Is it a lease modification? Okay, let's focus on that. What do you think when I say if there are lease modifications in a situation where there were no rental rebates or concessions which was mentioned in the original terms of your contract? If in your original terms of the contract, if there is nothing mentioned about rental rebates or concessions due to quarantine or due to lockdown, then obviously, logically speaking, it is a modification, isn't it? Why it's a modification? Because these reductions in the rebates and concessions due to lockdowns and business closures were not part of your original lease contract. But now remember what's happening now is that when you say rental rebates and concessions were given, IASB has now come up with an expedient, a practical expedient to be used as an option by lessees. So that's exactly what we are going to talk about now. So what does the standard say here? IASB issued an expedient in the month of May 2020 in order to support the ailing lessees. So what did they say? They said if there are rental rebates and concessions arising directly from COVID-19 business closures, such reductions can be considered as not a lease modification. So you can account for them as a remeasurement. You do not have to account for them as a modification, as per the expedient issued by IASB in May 2020. And remember again, this is optional, meaning if a company wants to account for them as lease modification, they can always very welcome to do that, but Nobody would like to do it when there is an easy way out. So the standard setter said, we give you an option. You do not have to account for rental rebates and concessions as loan modifications. Look at this. Lessee does not need to assess if the rent concessions are lease modification. They don't have to do it. Why they don't have to do it? Because COVID-19 rental concessions can be accounted for as if they are not lease modification, regardless of whether these rental rebates and concessions were there originally in your lease contract or not. So the standard is violating what they said previously, and now they say, okay, we are giving you a practical experience because there's a large number of concessions and rebates are there in 2020. So how to account for them? It increases the complexity of accounting and does not provide much information to the user. So they said, okay, let's use a practical experience. We give you an option. You can account for any rental rebates and concessions given by lessors to lessees as not lease modifications, right? So just to help them out, and the dates are very important if you guys understand what's here. COVID-19 related rent concessions issued in May 2020. Yeah, it was issued in May 2020. The lessee shall apply the amendment for annual reporting periods beginning on or after 1st June 2020. Early adoption is permitted and applicable for lease concessions up to June 2021. I think this is the most important date that you need to look at. The standard setters first said up to December, and then later they increased in May after various people opposed this, because usually the rental concessions were given up to 1 or 1.5 years in some cases. So now they say up to June 2021, any lease rental concessions can be accounted for as not lease modification. So that's the most important point to look at here. And this is done by IASB to help lessees who are already into so much financial distress, right? Hope that is clear. Right. So now we are moving on, and that's the end of lessee accounting treatment. We spoke about what changed from IAS 17 into IFRS 16. The key changes and key impact on the financial statements and the valuations. And we spoke about loan modifications, lease modifications. And in the lease modification, we split them up into remeasurement and then modification. In the modification, we said modification, creating a new assets and new leases, modifications, which are accounted for as part of your existing lease. Right? So that's what we looked at. And then we looked at lease modifications as arising from COVID-19, rental rebates and rental concessions. If you can prove these concessions are given specifically to help you out as part of your COVID-19 initiatives by the lessors, then that can be accounted for as not a lease modification. Right. Lessor accounting treatment. In the lessor accounting treatment, I mean, we said previously, I hope you guys remember IFRS 16 implementation basically changed only the lessee accounting treatment. Still, the lessor accounting treatment has not been changed. If you look at previously in IAS 17, the lessor accounting treatment was just a mirror image of the lessee accounting treatment. But now it is not the case. Why? Because in IFRS 16, they introduced a single lessee accounting model where all the assets and liabilities needs to be on the balance sheet, except for assets which are of low value and lease periods less than 1 year. Right. Now, when it comes to lessor accounting in IFRS 16, they pretty much kept the previous IAS 17 lessor accounting treatment as it is. So meaning that the definitions of finance leases and operating leases are still there. Such classifications are important for finance leases where the risk and rewards are transferred to the lessee. In operating leases, it's not transferred. So this is still there in lessor accounting. So you account for finance lease and operating lease. So basically the most important point for you to remember is that largely unchanged from IAS 17. Look at the blue box here. Finance leases, in the finance leases, what the lessor is going to do, he's going to de-recognize the asset from their balance sheet, and they are going to recognize a receivable. Why they are going to recognize a receivable? Because they need to receive the money from the lessee. So that's going to be the present value of future lease payments. But when it comes to an operating lease, what the lessee does, when it comes to an operating lease, the lessor continues to recognize the asset in the balance sheet and recognize a rental income in their income statement. And because it's an operating lease, so I mean, end of the day, you know, it raises a question whether the new lease accounting standard is creating an accounting mismatch in the books of lessee accounting treatment and lessor accounting treatment. Simply because they changed IFRS 16 lessee accounting, but they kept lessor accounting unchanged. So this probably going to be another future agenda of IASB of somehow syncing or aligning lessee accounting and lessor accounting, because at the end of the day, lessor accounting is a mirror image of lessee accounting, technically speaking, but that is not the case at this point in time in IFRS 16, simply because we are still going by finance leases and operating leases classification on lessor accounting, but we're talking about right of use assets and lease liabilities in the lessee accounting. So bottom line is IASB addressed the pressing issue in the standard, because the pressing issue was operating lease accounting treatment in the books of lessee. So by bringing up these changes, they address the key issue, which was a culprit behind many accounting scandals, and the largest one, as I pointed out, is Enron. So they came up with this revised accounting standard, so which can help users of financial statements to better understand the leases. Right, so now going to be the last topic of the day before I could take up any more questions is going to be sale and lease back. Right, so what do you mean by sale and lease back is basically, look at this diagram, it's pretty much self-explanatory. What is sale and lease back is basically, let's say you have an asset, right? You own them, you have the legal title of the asset which you are selling it. Why you probably are selling is that you want money. So you sell them and you get the money, but you need the asset. So what would you do if you need the asset and you want cash? Right, so what do you do? If you want the asset, you want cash, you sell them, get the money, lease the asset again. So you look at what's happening. You're selling the asset and the buyer is buying the asset, and he is leasing you back the same asset back to you. So what's happening? You have a seller, he becomes a lessee, and buyer becomes a lessor, isn't it? So that's a sale and lease back. So sale and lease back is basically when an owner of an asset is selling the asset to a buyer because he needs money, and immediately what the lessor does, he is leasing the asset back to the lessee. So the original owner of the asset becomes a lessee. So that's the situation we say sale and lease back. And IFRS 16 presenting accounting treatment for sale and lease back and how to account for them. Sale and lease back, remember when you are talking about sale and lease back, it is very important that you relate IFRS 15 revenue recognition from contracts with customers into account. It's very important. You need to understand if the transfer of assets, if it is a sale as per IFRS 15, because if you go back in IFRS 15, they prescribe what conditions to be met in order for a transaction to constitute a sale. So the question is whether this seller is selling the asset to the buyer. Is this a sale? Okay, you can answer me, yes, it is a sale. But what does IFRS 15 talks about it? As per IFRS 15, is this a sale? If this is a sale as per IFRS 15, what you need to do, and if it is not a sale in IFRS 15, what you need to do. So what they are saying is, if it is a sale as per IFRS 15, if this sale of seller selling the asset to the buyer, if it meets the conditions of IFRS 15, the seller accounts for right of use assets at the proportion of the previous carrying amount relating to the right of use assets, gain or loss recognized only to the extent related to the rights transfer. So what you need to do, if it constitutes a sale as per IFRS 15, you will have your existing assets, and from the existing assets, you will de-recognize them. You will create a new asset, which is what right of use assets. Remember that, because your existing asset is being disposed because it is a sale as per IFRS 15. So you de-recognize your existing asset, create a new asset equivalent to your rights of use. And that is what you do if it constitutes a sale. You de-recognize your existing asset, create a new asset which reflects your rights of use. Now, what if this does not constitute a sale, meaning that the seller still retains the control, the seller still has the managerial influence on the product, then it doesn't constitute a sale. You will have to go back and look at IFRS 15. What are the conditions to be met to classify and to become a sale as per IFRS 15. If it is not a sale, then what you need to do, you need to account for this as per IFRS 9 financial instruments. Why? In that case, the money which the lessor is going to give to the lessee, which is when seller is selling the asset to the lessor, and lessor is paying the money, the whole transaction should be accounted for as a loan. So it is like the buyer is giving seller a loan because he wants a loan, and the seller pays back the loan back. So you need to create just an asset and a liability in your respective books if it is not a sale. So remember that, that's very important. If it is not a sale, you do not have to de-recognize your existing assets. You just have to create a new assets, which is the receivable from your, you're going to debit your receivable. If you are the one who's a buyer, debit your receivable, credit cash, you're going to pay money to him. And what the seller is going to do, they are going to debit cash and credit liability. So this is going to be just treated as financial assets, receivable, financial liabilities, payable in the respective balance sheet. So that's the end of sale and lease back. And this is just a quick example of what you do when it comes to sale and lease back. You know what you do. This is in the books of the original owner of the asset. You are debiting the sales proceeds because you're getting money. You're selling the asset, crediting the asset value, which is the original carrying value of the asset, and you are debiting the right of use assets, which is the new assets, the rights because you are taking a lease back. So you cannot completely write off the asset, although because you have sold it, because you are getting it back. Understand the concept here. It's very clearly reflected. You are de-recognizing an asset. Why? Because you are selling an asset, but you're bringing back the asset again because you are leasing it back. Leasing it back means you have to show a right of use, but that amount may be different from what you de-recognize, because this is going to reflect only your rights of use. And then you are going to credit the lease liability for the same, and any difference between assets and liabilities is a gain or loss on the transfer, is a balancing figure. So this is what you do when you are talking about lease that are part of sale. But if they are not part of sale, as I previously mentioned to you, it should be accounted for as per IFRS 9. So what the buyer needs to do, he has to recognize a receivable, and seller has to recognize a liability because he has to repay the money back, isn't it? So that's the end of sale and lease back example, and then that's the end of today's sessions. If you have any questions, please raise it up here. Now there is a question from Ravi here. A lease agreement ending June 2022 has a break notice option. Okay, June 2022 you're talking about, right? As part of the break notice, if the company makes a termination payment now, how should this termination payment be recognized? So basically, just to understand your question, if Rafi, if you are there, now the question is this termination. So basically, you are using the breakup option. You are making a termination payment in order to cancel your lease. Are you making a cancellation of your lease, or you are taking a break? I would like to understand more on that to be able to answer that question. So are you canceling your contract, or are you taking a break now? Because at the end of the day, your answer is going to be depend on that. How should this termination be recognized? So first question to look at is this termination, was this expected at the time of originally when you recognized your rights of use assets and the lease liability? So that's another question. Okay, it is a cancellation. So Ravi is saying it is a cancellation. So you have a cancellation. So if you are a cancellation, the first thing is basically you need to understand that did you have a liability right before the cancellation in your balance sheet. You have a rights of use assets in your balance sheet. It is just that, you know, you need to write off your assets and write back your liabilities, isn't it? So you got to make a payment of termination, so that, let's say, it gets expensed, and then you have your assets and your liabilities. So you write off both of them, and there will be a residual impact on your P&L, because depending on whether your liability is bigger than your asset or your asset is bigger than your liability, so it can become an asset. It can become a gain or loss in your assets, isn't it? Hope that answers your question. So you need to, in that case, you simply have to de-recognize assets, de-recognize liabilities, and account for your termination payment. And you will have a residual gain or loss depending on the value of your assets and value of your liabilities, right? So there is an impairment to assets. Okay, there's a question on impairment testing from Aruna. Is that, so what you need to do if you are creating a right of use assets, and if you are measuring them using historical cost, and you are depreciating that over a period of time, remember, in that case, you got to carry out an impairment testing whenever an impairment indicator is present, right? So you got to carry out an impairment testing as per IAS 36, and any impairment losses should be taken to income statement, unless if you have a revaluation reserve, it can be charged against the revaluation reserve to the extent available, right? So the next question is, if a business enters into a 1-year contract without renewal clause, and then it is renewed with a new lease contract, then can it apply exemption clause? Now, this is a great question. I think, you know, this is going to be one of the practical problems that are going to come in. Yes, if you say, I mean, you are going for a 1-year lease and you expect the lease to be cancelled at the end of the year 1, but you did not cancel this and you are extending the lease. So previously, when you said it is a 1-year lease and there is no renewable option, if you are extending the lease at the end of the year, then you need to account for this as lease modification, isn't it? Because now it's becoming a lease. So if you're just extending it, although it was a lease, you did not recognize them in your balance sheet because it is actually less than 1-year lease. But now you are getting more indication. You might not know that at 31st of December. You would probably know in November that you're going to extend it. So now what I would say is this is a change in the scope of the lease. You are extending the lease term. Now it becomes more than 1-year lease. So you need to go back. You still have not finished your accounts, didn't you? You didn't. You have to go back from day 1, account for this as a lease with more than 1-year term. So it's very important that it has to be accounted for as a new lease, isn't it? Yeah, that's exactly right. It should be a lease modification and accounted for as a lease from the beginning. Right, there's another one more question. If the lease is 5 years but can be cancelled in 30 days notice prior to the next year's start, does this fall under rights of use assets in lease accounting? So end of the day, Shihab, you know, one of the reasons why IASB has come up with IFRS 16 is to make sure that the companies don't use any gray areas available and again get into off-balance sheet financing. So something that should be strictly avoided if off-balance sheet financing. So anything that companies are trying to do or changing the lease contracts or whatever in order to avoid a liability classified into the balance sheet, I would highly discourage such options. You know, I mean, I think when it comes to accounting and this profession, what is very important is ethics, because accounting I see as a profession dealing with public interest. So definitely I would think when you say coming up with specific cases like what you are pointing out is actually signaling me that, you know, probably these type of contracts are actually renewable, right? I mean, but as accounted for as non-renewable. So maybe, you know, companies can come up with new contracts with less than 1 year, but then later you extend the contracts. If that is the case, substance over lease term prevails. So, I mean, definitely, I think auditors have a role to play in this case. You know, it cannot be this simple, isn't it? Just changing your agreement with a 30-day notice period. You know, there's a lot of things. What about, you know, non-cancelable period, penalties for doing this? What is your historical experience of doing so? So many things needs to be taken into account before you just classify something off the balance sheet, isn't it? So that's probably what the best answer that I could give you at this point in time. Okay, now the next question from Hassan is that what if the fair value of the asset is not available? How do you calculate the interest rate implicit in the lease? Hassan, you cannot calculate the fair value, interest rate implicit if there is no fair value available. You need to go with incremental borrowing rate. Hope that makes sense to you, Hassan. You need to go with incremental borrowing rates. You know, if that is the case. Okay, doesn't any asset be classified under PPE according to the newer standard? All these assets are classified under rights of use assets. Okay, that's a great question. Again, I can take up that last question before we finish off. I mean, do we have any assets still go under PPE under the new standard? No. Even the existing assets under finance leases that were part of your PPE now need to be reclassified back into right of use assets. So you would only see these lease liabilities and right of use assets in your balance sheet, a clearer representation of your assets and balance sheet, so a better presentation of financial statements, better information to users, a kind of a better investment decision making overall, isn't it? We are moving towards more transparent and disciplined set of preparing financial statements, right? So you don't have anything left out in your right of use assets, right? So I think most of the questions I have taken up, there have been so many questions coming up, so I'm going to have a look at them and definitely get back to you to your respective email address if I have not answered any of your questions. And it was definitely an interactive and valuable 3 hours for me, and thank you so much for joining from different parts of the world for this webinar. And thank you so much for participating, and I look forward to seeing you in the future sessions. I have various questions to look into to do future IFRS sessions. You know, what I would actually do is shortly after the session, I will do an update in LinkedIn as well as FB. I will do a post, and please share your experience in the webinar, and also you can mention what standards you would like to for me to discuss in the future. Definitely, I look forward to having you in a future seminar. Right, so I'll email back to you with my LinkedIn link with my post, and please share your experience. I will greatly appreciate, and please mention any of your future requirements, and please feel free to reach out to me in case if you have any IFRS classifications or clarification, any issues that you practically face in estimating the terms of the asset, or whatever complexity that you face with modifications or whatever, not just this, any accounting standards. Please feel free to reach out to me. And thank you so much. It was really great seeing you, and great comments. We had a very useful 3 hours. Thank you so much, and I look forward to seeing you in the future.